Welcome back to Three Simple Things, a Gennari Aronson series of tips and information from our corporate and transactional practice. Say you're looking to sell your business and you've received a proposed letter of intent from a potential buyer. You're intrigued by the price, but the transaction structure itself is vague, proposing to acquire either the assets or equity of the company. You may wonder to yourself, if the price looks good, do I really need to worry about the structure? The answer is yes, for a number of reasons. Let's break it down. First and foremost, asset sales and equity sales involve very different mechanisms by which the buyer would acquire your business. In an equity sale, the buyer buys the ownership interest of the company directly from the owners, and as a result, takes over the existing legal entity. That means, however, that you'd need every single owner to agree to sell, which could be a difficult and time consuming, i.e., more expensive, process. In an asset sale, on the other hand, the buyer will be purchasing assets, including physical assets like inventory or equipment, as well as intangible assets like receivables, brand names, and customer records from the existing company, but leaving the entity itself behind. Another key difference between the structures is the buyer's level of control over what they're buying. In an equity sale, the buyer is acquiring the existing entity as a whole, warts and all. If the entity is being sued by a third party or has outstanding debt, those obligations will remain the obligations of the entity as owned by the buyer, although buyers typically expect the selling owners to be responsible for those liabilities. In an asset sale structure, however, the buyer can not only pick and choose which company assets it wants to take, but can also pick and choose which liabilities it wants to assume, if any. Those assumed liabilities are then transferred to the buyer, and anything left behind remains the obligation of the existing legal entity. Perhaps the most important distinction between an asset and an equity sales structure is the tax impact on the parties. Generally speaking, from a tax perspective, sellers prefer equity sale transactions and buyers prefer asset sale transactions. This is because the proceeds in an asset sale can potentially be taxed twice. Once as income received by the company, and then a second time when those proceeds are distributed up to the corporation's shareholders. For a buyer, on the other hand, there may be tax advantages to an asset structure. The bottom line is this: the choice of transaction structure can have a major effect on how much the sellers can take home after taxes, and should therefore be considered a key term to be negotiated and built into the letter of intent. As always, this is just a brief overview of some of the basic considerations involved in structuring sale transactions. At Gennari Aronson, our attorneys have decades of combined experience handling complex M&A transactions, so please don't hesitate to reach out if we can be of assistance to you and your business.